Hello, today we're going to talk about money. Money is not everything, but it's almost as important as the air that we breathe. But at the moment we're born, we already know how to use the air. With money, the story is different. If you want to prosper in today's world, you need to learn about money. So, I would like to ask you a question. Where did you learn about money? Have you thought about that? While you think, I will introduce you to the company in which we work. Five Rings Financial is a financial consultant company. Our focus is financial education. We believe that the person well informed will make the right decision for her family, and for her future. We go to school for many years and we learn about math, English, geography, but we don't learn about money. So if we don't learn in school, where do we learn about money? We learn in our home, observing what people do. Most likely, you do with your money what your parents used to do. And I'll go even farther. Most likely, your parents do with their money what your grandparents used to do. It goes from generation to generation. And I'm telling you that this is a great plan if you come from a rich family. There is a lot of financial concepts that we need to learn. The goal here is to learn and understand. Now that you know a little bit about my goal, I would like to know your goal. Would you like to save money for the future? To protect the money you already saved? And learn more about money and pay less in income tax? A lot of people that comes to our Money 101, they want to know what to do with their money. So, first thing I share with them is the US financial history for the last 30 years. Those are the most volatile years from the American economy history. Because from 1980 to 2000, the stock market just went up. It was year after year that people invested in stock market, in mutual funds. This happened so fast that between 1999 and 2000, it was the year that they sold most stock on the stock market in the history of the United States. But between 2000 and 2002, the stock market dropped 46%. It was the first chance that we had to lose half of our investments. But a lot of people kept their money on those accounts because they thought that the stock market was gonna go up again. And that's what happened. The market rebounded. Everyone celebrated this recovery. But it was a fake recovery because it returned to zero. It works like this. Supposedly that you have $10,000 and you give me this money. Then I'll invest your money and I'm gonna like gain and lose, gain and lose, gain and lose. And then after 10 years, I bring back your money and I give you $10,000. So is this a good investment? Of course not, because they just went back to zero. And that's what they celebrate. Now, if you were here in 2008, you already know what's gonna happen. Between 2007 and 2008, we had the second chance to lose half of our investments. The stock market went down 56%. The financial crisis of 2008 was not only a problem in the stock market. The real estate market also lost. Homes lost half of their values, and many people stopped paying their installments. And as the banks needed this money to make loans for companies, banks stopped lending money to companies. Companies lacking working capital laid off many employees. So at this time, many people were left without their home, without their work, and without half the money they invested for their retirement. This was the financial crisis of 2008, and who was here will never forget. Now the stock market went up again. Many people were afraid to invest in stock exchanges. Half of the investment accounts today are safe.
When it comes to retirement planning, there are three kinds of people. The guy who doesn't think about or plan for retirement, you don't want to be that guy. The gambler type who feels the only way to grow her money is to risk losing it all in the stock market, and the play it safe type who shudders at the thought of losing a single penny of his savings, even if it means sacrificing any opportunity for that money to grow. For years, retirement planning has been vastly limited to choices that fall on one side of the scale or the other. And so, money-savvy people tend to invest in 2, 3, 14, 50 different products in an attempt to balance the scale. But what if there was a way to capture the upside potential of a risky product and the downside protection of a secure product all in one solution?
So, where is the best place for our money to be here on this financial seesaw? Right in the middle, right? So I'm going to explain to you the middle. The middle works like that. You have a money and you say, Renata, I want my money to go up when the market goes up, but I don't want to lose any money when the market goes down. And you tell me, Renata, this is so good to be true. And I'm telling you, it's not only so good, but it is true. There are financial products today that does exactly this with your money. But we didn't know that before because we didn't learn finances in school. And now I would like to ask you a question. Is it possible to create a pile of money? Yes, it is possible. But why we don't have that money? There are beliefs that limit our ability to create a different financial future. The first one is to believe that you have no money. The person comes to me and says, Renata, I cannot save any money. The money I make, it's almost not enough to pay my bills. But don't worry, when I have a raise, I come back and I'll talk with you. Have you heard that before? You know what happened? When you make more money, you spend more money. If you want to change your financial future, you only have to do one thing. You have to pay yourself first. If from everything you make, you pay yourself first, I can guarantee you that your financial future it's going to be different. This concept was written in a book and I advise you to get it. And the book is The Automatic Millionaire. And this book speaks about this concept, paying yourself first. I want to share with you what happened with Mike, the owner of Five Rings Financial. He created this company 35 years ago. He was 26 years old. He was broke with $35,000 on credit card debt. One day he received an invitation to go to a financial seminar, and he thought with himself, I think they invited the wrong person to the wrong place. And he thought, who would invite me for a financial seminar? He was not sure, but he went anyways. And in this talk, he heard that the rich get richer and the poor get poorer. The only difference is lack of financial education. The United States doesn't have any financial problems. We have financial education problems because how can we live in the richest country in the world without money? So he sat down to hear the seminar, and at the end, he spoke with a financial consultant to analyze his financial situation. And when he sat down to talk with the financial consultant asked him, Mike, do you think it is possible to save $5 a day? And I would like to ask you this same question. Do you think that you can save $5 a day? Yes or no? Because $5 a day is nothing. We spend about $20 a day, and I'm gonna show you how. On the beginning of the week, you go to work and it's Monday, and you think with yourself, oh, I'm gonna buy a cup of coffee. Then you buy this cup of coffee and spend about, it depends on the place where you go, you spend about $5, $6. Then Tuesday, you don't spend money with coffee, but you buy lunch somewhere. Then you spend about $10, $12. So on Wednesday, you buy coffee in the morning and lunch. So then you spend like more than 20 for sure. So you talk with yourself, Wednesday and Thursday, I'm not gonna spend any money because I already spent too much. So Thursday and Friday, you don't spend any money until about 4:35 in the afternoon. Who knows what starts between 4:30 and 5 o'clock in the afternoon? The happy hour. And what is the happy hour? The happy hour is the beginning of your weekend. The weekend is great for ourselves, but it's horrible for our money. Because it's on the weekend that we have a baby shower, that we have to go, that we're gonna go out for dinner, that we're gonna go to the movie theater with our family, that we're gonna go to have a breakfast, lunch in a friend's house and we share dishes. It's over the weekend that we're gonna have fun. We go out with our family. And of course, before all those things, we need to stop by at Macy's because we cannot do all those things during the weekend with the same clothes. We spend about $100 to $200 in a weekend. And the problem is that today we don't use more our money in cash. We use our credit cards. Do you know why we spend more when we use credit cards? Because we don't feel the loss. We spend, we pass the credit card, and the card returns to our pocket. So we don't feel the loss. We spend 20 to 35% more when we use credit cards. I'm not telling you not to live life. I'm telling you, instead of spend 20, save 5 and spend 15. The consultant was explaining to Mike, $5 a day for 40 years with a 10% yearly rate, you can make $1 million. I'm not telling you that you can get rich tomorrow. I'm telling you that you can get rich in the future. Then Mike say, wow, $5 a day? Oh, count me in. I can do that. Then he multiplied 5 times 30. And why he multiplied 5 times 30? Because a month it's 30 days. So $5 a day for 30 days is 150 per month. Then Mike answered him, are you crazy? No way. Isn't that funny that $5 a day is nothing and 150 a month it's too much? Oh my god, now I have to think. And why do I have to think? Because this is an emotional reaction to money. Because on logic and mathematics, they are the same thing. For you to win on your financial future, you need to learn how to use the logic and mathematics, not emotion. So the financial consultant showed him something that we use here, the financial funnel. And what do we do with the financial funnel? We find lost money in your budget. I'll explain to you how. With the financial funnel, we look for everything that is taking money out of your pocket. Bills, insurance, expenses, anything that takes money from your pocket. Then we evaluate. Is it essential? Can we reduce it? Can we exchange it? Or can we control it? You know something that is not essential? It's the gym that you pay on a monthly basis, but you never go there. The second question, can we reduce it? Because there is some bills that we can reduce it. For example, the car insurance. How long do you have your car insurance with the same company? How long ago did you look for a better price? What happened with car insurance? I'm gonna explain it to you. Every time their company wants to get more clients in a region, they lower that price on the zip code area. So a lot of people change it to that company that has the better price, but with time they raise and you don't feel it. But what you don't know, there is another company that wants to get new client on that zip code. So there is another company with a better price that lower their price. So once in a while we need to search for better price on our car insurance. And then we ask also, can we control it? Something that we can control, it's the supermarket bill. What do we need to do to spend more when we go to the supermarket? Well, we go hungry, we go without a list, we bring our kids with us, and we bring our kids hungry. Then there's no way we're going to spend more. A good way to spend less is bringing cash. For example, if you spend $150 on the supermarket, just go to the ATM, cash 150, leave all the cards in home, and I can guarantee you that you're not gonna spend more because you're gonna use one emotion in your favor. You're gonna be afraid of embarrassment because who wants to buy a lot of things and then get to the cashier and see that they don't have money to pay? We need to change our behavior today because if we don't change our behavior today, nothing is gonna change tomorrow. Usually we find between $200 to $300 hidden in our client's budget. I want to show you two rules that it's gonna make you win on your financial life. The first one was called by Albert Einstein the eighth wonder of the world.
A pretty smart guy once said, "Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it." Compound interest. It may be compound, but it's not complex. To help understand compound interest, let's first take a look at simple interest. Say you have $100 earning 5% simple interest. This means that every year your balance will increase by 5% of your principal, in this case $5. Compound interest, on the other hand, is interest that compounds annually, meaning the interest you earn each year is added to your principal, thus earning its own interest the following year. It's interest on interest. Interesting. So with simple interest, your balance's growth is constant, but with compound interest, not only is your balance growing, it's growing at an increasing rate. The true beauty and sheer power of compound interest reveals itself over time. Using our previous example, after 30 years, you'd have accumulated a total of $250 in your simple interest account. Not bad. But that same account using compound interest would have a whopping $432.19. That's 73% more money for your pocket. So as you can see, compound interest can be your best friend if it's working for you. It's also important to realize it can be devastating if it's working against you. Think credit cards. Turns out that Einstein guy knew what he was talking about.
The next rule, it's easier. We're gonna talk about income tax.
If you're like most of us, you have a problem. You need to save more money for retirement. Like, a lot of money. But how? Sure, you could sell a kidney or put your daughter's Beanie Baby collection up on eBay, but before you do that, let's look at a more practical option. The only way to save more money without making more money is to pay less. I'm talking about taxes.
What are we talking about? Practice?
No, taxes. The single greatest difference between wealthy and middle-class Americans is the amount of time and effort the wealthy spend thinking of ways to minimize the effect of taxes on their savings. So how significant is the effect of taxes? Check it out. Here are two identical accounts. Both start at $1 and double every year. After 20 years, the balance in the non-taxable account amounts to over $1 million.
Holy moly!
So what happens in the taxed account? Well, the majority of Americans are in the 28% tax bracket. So we'll start with $1, double it, and tax it.
Double it and tax it. Double it, 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 tax it.
After 20 years in a taxed account, your balance is $51,353. Big difference? I'd say. Sure, you paid a lot in taxes, but the crippling effect of taxes on the earning potential of your account goes far beyond what you pay to Uncle Sam. Of course, the millionaires and billionaires of this world know this lesson well. Let's face it, Bill Gates and Warren Buffett didn't build their massive fortunes by letting Uncle Sam get his share of every dollar they saved. So how do we protect our money from taxes and make sure they don't cripple our savings? There are financial instruments out there that hold the answer. And now, you're asking the right questions.
Now that you know the rules, let's talk about strategies. When we sit with our clients, we talk about 3 levels: foundation, accumulation, and distribution. We'll start with the foundation because is it possible to build a house without a foundation? Yes, you can do that, but the house is gonna fall on the first storm. And on our financial life, it works like the same thing. And what is a foundation on our finances? It's to keep our income above our expenses. This establishes my foundation because I'm gonna start having money to save for the future. The second strategy is something called living benefits.
When Alexander Graham Bell invented the telephone in 1876, he designed it to do one thing: make phone calls.
Hello?
These days, it seems we use our phones for everything but phone calls. Today's phones are our text messengers, calculators, books, planners, navigators, our cameras, music players, internet browsers, stock traders, even our flashlights. Phones evolved to include so many other useful features because we needed them to, yet we still just call them phones. This same evolution by necessity has happened with other products over the years, and life insurance is no exception. When life insurance was invented way back in the 1600s, it was also designed to do one thing: to financially protect your loved ones when your life is over. And like phones, life insurance evolved because we needed it to. With modern advancements in medicine, suffering a critical illness like a heart attack, stroke, or cancer diagnosis no longer necessarily means death. In fact, 90% of people who suffer a heart attack these days survive that event. That's where the new, evolved kind of life insurance policy comes in, one that adds living benefits. Living benefits policies are essentially the smartphones of life insurance. They allow your life insurance policy to not just be a parting gift, but also provide the ability to accelerate the death benefit if you suffer a critical, chronic, or terminal illness. This ability can help save your financial life by unlocking a whole new list of ways to use your policy while you're still living.
Hello?
And oftentimes, it does all of this at the same price as the old kind of life insurance. Living benefits protect you, your loved ones, and your wallet, not only in case you die, but also in case you don't. Two things always happen when you suffer a critical or chronic illness. Your expenses go up and your income goes down. When your expenses get higher than your income, that's when debt begins to pile up. This is the exact trap that so many Americans are falling into every single day. In fact, 60% of all bankruptcies that occur in the U.S. are the direct result of a critical illness and the medical expenses that follow. With living benefits, the policyholder has the option to accelerate a portion of their death benefit to replace their income and help with those added expenses. These benefits are the difference between just surviving the illness and having a life afterwards. And the best part is, they come at no extra cost to the consumer. So what kind of life insurance is protecting your family? Your granddad's traditional death benefit only coverage?
I don't know if I'm hearing anything.
Or the new evolved life insurance with built-in living benefits? If you're still using the rotary phone of life insurance, maybe it's time for an upgrade.
I want to share with you about something that happened with one of our customers.
My name is Joelma Diaz. This is my living benefits story.
My name is Rickson Amorim. I live in Boca Raton, Florida. I've been in the insurance industry for a little over a year.
I met his cousin at the beginning of the year. Then I met Rickson in April.
We had an event in my church with my cousin Paulo, and she attended this seminar. After that, she asked for an appointment with us.
I never heard about the living benefits. That was one of the reasons that I decided to make the life insurance. So it's just something that, I think that's a good idea. I'm gonna do it. I even told some friends, I told my family about it. So I think it's a good idea. It's something to have it.
The policy was issued, everything was fine. 2 days after I delivered the policy, she suffered a stroke.
I went to church, I was with my friends, and my right side got weak. But I was normal, I was talking. My friend told me, you had a stroke. I said, no, I did not have a stroke. I'm gonna go home. She said, no, you had a stroke. So you're gonna go to the hospital. But after I went to the hospital, I don't remember what happened.
I was very worried about her health at that time.
I was in the intensive care for 4 days. Then I went to the other side of the hospital for another 4 days. They sent me to a different hospital for 3 weeks. So only I was there for a month.
I knew that we could do something for her because she had the living benefit feature in her policy.
At the time that I was in the hospital, I was worrying about my health because I didn't know what to expect when I get home. But I also was worrying that how I was going to pay my bills. Because if you don't work, you don't make money. And the bills don't wait for you to get healthy. He called me and said, he asked me, Joelma, what are you doing? Sit down, I have something to tell you, but you have to sit down first.
The outcome of that claim was a check of $54,212. Even her voice changed over the phone when I say, hey, do not worry about this. I have to worry about this. You worry about getting better, okay?
I said, wow, my God, I could not believe it. I was ecstatic.
If she didn't have a living benefit feature attached to that policy, I don't know what she would do it today.
I never thought I was going to have a stroke. I was doing fine, no problems, going to work every day, doing my thing. But nobody thinks they're going to get sick.
Living benefits, it's a feature from a life insurance. It's basically the new kind of life insurance. A regular traditional old life insurance only pays upon death. So with the living benefit, our clients are able to accelerate some of the death benefit if they have a major illness.
When I got sick, and especially when I really got the living benefits, I was so happy that I made the right decision.
She told me that she was like, oh, I almost didn't do it, but something told me to do it. So I'm really happy that we made that decision that day.
Thank God I was able to get the life insurance and the living benefits. I tell everybody about it. I tell my friends, I tell my family, you have to do it. Because I'm a living proof that it does work. It is true.
The next step that I want to share with you is about accumulation. There are only two rules to accumulate money. Rule number one, never lose money. Rule number two, never forget the first rule. Simple like that. And I did not create this rule. Warren Buffett did. And why am I talking about Warren Buffett? He is one of the richest men on earth. And what do I do so I don't lose money? The strategy we show to our clients. They are the indexed plans.
Your IUL's performance directly reflects the performance of the stock market index while implementing a 0% floor and a market cap, usually around 10%. So your cash value participates in the growth of the market up to the cap and sits safely on the sidelines when the market goes down. You forego some of the upside to alleviate all of the downside. So zero is your hero. With IUL, you won't spend a single day of your accrual making up for losses. Pretty cool, right? Well, it gets better. When designed properly, IUL can serve as a retirement vehicle based on a financial chassis of life insurance protection. And because of IRS tax code exemptions for life insurance, your cash value can create a tax-advantaged way to generate more income in retirement. That's something your 401k or IRA simply can't offer. So what might an IUL look like for you? Let's talk specifics. Larry here is in decent health, a non-smoker, and contributes $500 a month to his IUL starting at age 35. This contribution is conservatively projected to generate $500,000 of cash value by the time Larry retires at age 65. If he chooses to, Larry can turn on a non-taxable income stream from his IUL, giving him $60,000 of income per year to supplement his retirement. And the longer he waits to access this money, the larger it can grow. That death benefit is even accessible when Larry's still living if he suffers a critical, chronic, or terminal illness. So if Larry gets sick, he's covered. If he dies unexpectedly, his family is covered. And if neither of those things happen, the money Larry's paid into his IUL over the years can fund a happy, healthy, tax-advantaged retirement. Assuming Larry lives to age 90, he will have contributed a total of $186,000 into his IUL, drawn out $1.5 million in non-taxable retirement income, and still leave behind a very sizable tax-free death benefit for his heirs.
And I also want to talk about planning for college costs.
We're parents, and as parents, we love and want what's best for our kids. Raising a kid in today's society isn't easy. There's all kinds of new dangers that we have to watch out for that our parents didn't. One of the biggest concerns to this generation of kids is the rapidly rising costs of college. According to Forbes, a $10,000 college education in the year 1986 would cost $59,800 in 2015. That's over 2.5 times the inflation rate. The good news is that's not stopping kids from attending college, as more students than ever before are pursuing higher education. The bad news is they're being forced to pay for their tuition with borrowed money. And today's college graduate is striking off into the real world bright-eyed, bushy-tailed, and already buried in an average of $35,000 of student loan debt. $35,000 sounds like a lot, but not entirely unmanageable, right? After all, they have their whole career in front of them, and plenty of time to pay it back. A recent study by LIMRA found that a college graduate saddled with $35,000 of student loan debt would end up with upwards of $350,000 less in savings when they reach retirement. That extra time spent paying interest on their debt rather than earning it in savings adds up in a big way over the long haul. So we know that saving for college is important, but what's the best way to go about it? Certain financial vehicles have been created specifically for the purpose of saving for college costs, like the popular 529 plan, CSAs, UTMAs, IRAs, education savings bonds. The choices can be overwhelming. It's critical to understand your choices and the advantages and disadvantages for each option.
And now we're going to talk about distribution. Remember, foundation is the base. Accumulation is to save for the future. And distribution is the ultimate goal of this game. And why am I talking about finance? Well, I'm going to take care of my money today, so in the future, the money that I took care today can take care of me for the rest of my life. And how is the best way to do that? Do you prefer to have a stack of cash or A guaranteed income for the rest of your life. What do you think? Here in the US, a lot of people prefer to have the stack of money. Then they retire and spend this money in max 6-8 years. 70% of the elderly that depend on the social security only, they live below the poverty level. This is one of the reasons that they have to return to work after retirement. We don't want to live that way. So I hope you have learned a lot today. And if you have any question about compound interest, tax-free retirement, Rule of 72. The Rule of 72 works like this.
So you've got a chunk of change, and you're smart. Enough. So you put your money into an account that gains compound interest. So how long does it take for your money to double in that account? Well, to find this out, you need two things: your balance and your interest rate. Now, like most things, there's an easy way to find your answer and a hard way. The hard way involves taking the logarithm base 10 of 2 as in 2 times our balance, over the logarithm base 10 of 1 plus our interest rate. Since most of us don't have bionic brains, we can't really do this math in our heads. But our friend Larry is here, and he's going to give it his best shot. We'll get back to him later. Luckily, there's a simple way to approximate how long it takes for your money to double in a compound interest account. It's called the Rule of 72. How does it work? It's surprisingly simple. All you do is take the number 72 and divide it by your interest rate. That's it. It's that easy. The number you get equals the number of years it's going to take to double your money. So let's try it out. Say you have $5,000 in your account earning 4% interest. Now take that magical number 72, take your interest rate of 4%, pull out your phone, text your second grade cousin and ask him how many times 4 goes into 72. He's a bright kid, so he'll tell you the answer is 18. And you'll tell him that he just helped you learn that it will take 18 years for your initial $5,000 to double into $10,000. Let's check in on Larry. That's very nice, Larry. Luckily, with the Rule of 72, there's no need to ever use the hard way. Using the Rule of 72, we can easily see how small changes in interest rate can make a huge difference in our earning potential. A 29-year-old earning 4% compounding interest can expect his account to double twice by the time he's 65. At 8%, it doubles 4 times. At 12%, it doubles 8 times. So by doubling your interest rate from 4% to 8%, you actually quadruple your money. And by tripling your rate from 4% to 12%, you 16-tuple your money. Is that a word? It is now. Interest rates matter. The Rule of 72 helps us understand just how much they matter. So how many doubling periods does your nest egg have before you retire? Now you know the easy way to find out.
The Rule of 72, it's a great way to know how long it will take for your money to double. We need to understand also about college plans, life insurance with living benefits, or if you want to be part of our team and help others, just let me know. It's gonna be a pleasure to have you with us. God bless.